Hello and welcome to Wrestling with Real Estate, where we look to chokeslam all your real estate problems. I'm your host, former WWE wrestler and now Cirque du Soleil performer, and of course, multi-family real estate investor, Barri Griffiths. Now today we're joined by Rob Luna. Hey Rob, how you doing, man?
I'm doing great, man. I'm excited. This is a different format. I'm pretty pumped up about this. I'm ready to jump off the top rope.
Don't be scared, man. Yeah, jump. And man, you're looking sharp, man. I told you beforehand. I should have at least worn a coat or something to look. You're looking really good. For people on the video that get to see it, you're looking awesome, man. You're looking super sharp.
Appreciate that, man.
Well, Rob, hey, this is going to be a fun interview. I'm really excited for this today. But before we kind of dive into the conversation, can you give the people an idea about what you've been up to, what your current focus is?
Yeah, so, I've been in the private wealth management space all my life since I'm 19. I started my own investment advisory firm dealing with institutional investors, high net worth, ultra high net worth investors now for about 15 years. Recently sold majority interest to a publicly traded company. So I'm looking actually, and why I'm doing this podcast is to reach beyond just the ultra high net worth person and try sharing a lot of my knowledge with the general public, because we hear about this wealth gap in our country. Everyone's whining and complaining about it, but no one's really doing anything. And for me personally, grew up very poor. It was education that saved my life and opportunities that arose from that education, which got me to a pretty good place to where I'm at today. So I'm looking to share back with those types of things today. But for your listeners, I do a show called Making Money on Fox Business with Charles Payne every Friday, where we talk about the economy. But my expertise is really in multi-asset class investing. So obviously the stock market, but I've done tons of real estate deals personally, from multifamily to single family. I work a lot with Blackstone, who a lot of people have probably heard of as one of the largest real estate investors in the world. So I guess the perspective that I can bring to your audience, if we're going to talk about real estate, is we take really a top-down global economic view. We'll also look at the microeconomics and look at how is that going to really impact where is real estate going, whether that's on the residential side, whether that's on the commercial side. For example, I'm in a story, high-rise, Class A luxury building right near Beverly Hills here today. A lot of vacant office space here. And I think that's going to continue because we've seen, obviously, what's happened with things by COVID is this work from home is a real thing. You see companies like Google now saying, well, we'll probably keep a large part of our workforce, maybe remote indefinitely. And so just to give you an example with that, when you start thinking about what does that mean for the big trend in commercial real estate, well, you probably don't want to be putting your money in a place like that right now. So those are the types of analysis that I bring to the table for my clients when we look at deals. And then obviously with the finance background, kind of looking bottom up to say, does that individual deal make sense? But we're looking at everything right now.
Really interesting. Yeah, a lot of interesting stuff today. I'd be interested when you said when you were 19 is when you kind of got into this business initially. What brought you into that business at that point, and how did it come about?
Yeah, well, like I said, I grew up really pretty poor in the inner city LA, and but I always really liked nice stuff, and so I would look and ask questions even as a kid. What are you doing? I started actually when I was a kid. When I was 15, I started a sports card and memorabilia business, and what I would do is start looking at AAA baseball players in particular, see who the hot prospects were, and then when they would release their rookie card, I would buy stacks and stacks of them. Now, obviously, some of those didn't work out, but a lot of them that I bought for $1, $2 went to $20, $30, and I would sell them, not unlike the stock market. And so kind of my first foray in the stock market was my freshman year in college. There was an internship opportunity with Waterhouse. I got into there, like I said, when I was 19. I'm a little older than 19 now. And I just kind of stuck with it because I think most people, they get into things, they quit too soon. I look at a lot of people who started as stockbroker trainees with me. The going got tough. They bailed out. They went from this job to the next, and they're still trying to find the next best thing in their 40s. So I just kind of stuck with it. And my idea was just to kind of become the best that I could at that, deliver the most value to my clients. And delivering value, becoming really good, it takes a lot of experience, and it takes, like, not only successes, but it takes mistakes and making those mistakes and learning from those, and then being able to share those with other people to hopefully prevent them from making those kind of mistakes.
Yeah, and I think exactly what you said there is also dedicating yourself to something, right? Picking a space and being in that and trying to be the absolute best in that, right? You know,
Yeah.
I think the successful people hear it time and time again that their ambition is to be the absolute best, to be dominant in whatever aspect of that business that they're going after. And I think that's such an important thing to factor in as well. You touched on something there earlier as well, and I'd be interested. And you know, there's no doubt about it, right? That the wealth gap is growing, right? It's not getting smaller, unfortunately, it's getting bigger. And you know, it seems like the middle class is just sort of slowly disappearing. But, you know, what do you advise people, right, you know, to help them, you know, because obviously finances and financial literacy is not that common, right? It's unfortunate, but it's the truth of the matter is. And you know, what kind of aspects of what kind of stuff do you talk about and trying to educate people on?
Yeah, I mean, well, you're right. I mean, financial literacy is not in our schools. And I'll tell you, like, even in college, I mean, you really have to specialize in economics, in finance. And even then, you're not getting a lot of the real life lessons out there. And so I've actually started an online academy to help train people in some of the basics out there that we're, you know, doing with people right now. But, you know, what I really look at when I look at the economy and the environment overall today, it is challenging, right? I mean, because, you know, first of all, it used to be you can graduate from high school, get a job with General Motors or whatever the case was, work there all your life, collect a nice pension, and you're okay. Well, you know, those things are gone. You know, there's no pensions at all anymore. There's no major U.S. corporations anyway that are offering pensions to people. So now a couple things. When you get a 401k, a lot of people think, well, I put money in my 401k and somebody's watching it for me. They're not. You basically are your own pension fund manager now. So do you have to be a huge analyst? No, but you have to know the basics of personal finance because nobody's going to care more about your money than you do. So you have to educate yourself by whatever means that is to make sure that you're not taken advantage of and you're setting yourself up for success. The other thing that I would say, though, is that with artificial intelligence, offshoring, all these things that are disrupting our economy and taking a lot of jobs away, the decade of the entrepreneur, you really need to be able to create a job for yourself and really hopefully create jobs for others as a small business owner, because it's just really, really difficult these days to go and work for somebody else. I see it all the time, even working with corporate executives. You know, people get downsized all the time. They get cut out. And, you know, if you're making $200,000, $300,000, $400,000, $500,000 a year for one company, well, you have a lot of knowledge and value to that specific company. But when they cut you and you go out into the open market, good luck trying to replicate that. And if you're 45, 50 years old, you're going to be a lot in trouble, especially if you've created a lifestyle that needs to be sustained by that income. So we teach people how to build small businesses, whether it's creating an online store. You know, to your point, I always tell people I can give you the formula that I created a business and sold, you know, majority interest for several millions of dollars, that I work with other entrepreneurs on. But what I can't do for you is give you a value proposition, give you a specialization. And like I tell people, I don't care what it is. It could be real estate. You know, I love watches. It could be being the best analyst of, you know every watch out there, Patek's, whatever it is, and you want to resell watches in the secondary market. If you know watches better than anyone else, I could show you how to be a millionaire. Whatever it is, though, you've got to be better than anyone else. Like you said it before we went live here, when you were wrestling, you weren't worried about how do I invest in real estate or how am I going to do my next job? Because I work with a lot of NFL players. You really can't. If you're going to be great, you need to spend the vast majority of your time honing your craft, being the best out there. And if you would have went in with 1 foot in and 1 foot in the real estate world, you probably wouldn't have lasted as long as you did. You wouldn't have had the successes that you did. So once you finished, you transition, and now you're full into real estate, which is why you're doing this. So that's kind of what I tell people. You've got to learn personal finance. You've got to look at creating a business, whatever that is. And most importantly, what you should start doing today is finding out what it is that you're better at than anyone else in the world and start really working on that and marketing yourself. No one's going to sell yourself better than you. So find out what it is and tell the world about it. And now with YouTube, Instagram, you know, my daughter who's 13, she doesn't know Tom Cruise is or any of these people, but she knows all the YouTube stars. And so everybody's got a platform these days.
Yeah, and the YouTube thing is amazing to me. Like so many
Yeah.
YouTube millionaires now, right? They're making so much money. It's amazing and great at the same time, right? Because essentially you have a home studio at home, right? These people, a lot
Yeah.
of people, they start with even just their camera phone. They're using their camera phone and they're able to create extreme wealth. It's just amazing the opportunity that's out there. It's more than it's ever been before, I feel like.
Oh no, it's a ton of money. You know, my friend, if there's a show called $1 Million Listing, Josh Altman, he's here just down the street from me. I was talking to him we're at a birthday party the other day. He's saying half the people he's selling homes to now in the Beverly Hills area are some of these YouTube stars, 19, 20, 21 years old. And they're buying 10, there's not cheap homes here in Beverly Hills. And so they're making the money through YouTube. And, a lot of people could throw sand at them, but, good for them. They've figured out what it is. They're adding value and they're monetizing it. So yeah. I'm all for it.
Yeah, it's incredible. It's incredible. And you touched on something else there that I'm passionate about is like, so people, before you could, like you said, you could climb the corporate ladder, right? And, retire with a pension. But now, something else with that as well is that on that, yes, it's great to have a, job, work hard, be a W-2 employee. But what happens if that employee decides to liquidate your job, right? Liquidate the business. You're at complete the mercy of them. You have zero control over your life at that point, right? And what I'm passionate about is, like you said, maybe start a business on the side of my business is real estate, right? And it doesn't need to be that you're flipping houses every weekend, right? It doesn't need to be that you're cleaning the toilet, fixing the toilets on a midnight, right? That's everyone's fear, right? But there's ways to invest in real estate where you can start to have that nest egg, right? To have that other option, to have something else to fall back on. So you're not reliant on your W-2 job, that you're not reliant on these big companies to keep you. And then, because I've heard stories of people that they were 55, right, getting ready for retirement, they were all there, and then all of a sudden, bang, you go ahead. And where do you go at that point, right? At that point in your life, where do you go? That's got to be a very trying time for someone at that point. So that's why I'm, one of the many reasons I'm passionate about real estate. With what you guys do, you mentioned it a little bit there with real estate. I'd be really interested to dive a little bit more about how you guys look at an investment, right? If someone, how do you work with operators and then bring them in, or do you guys do it in-house yourselves?
Yeah, we do a little bit of everything. To your point, though, I think, really real estate, just like the stock market, just like private equity, anything, you can look at it two ways. You can look at it, one, capital gains. So, like you said, there's guys that are looking to, or girls that are looking to buy, fix up, flip, or whatever the case may be. Or you can look at it really as a storer of wealth. And as a secondary, in a lot of cases, primary income source. So you mentioned you do a lot of multifamily. If you look at multifamily historically over the last 30 to 40 years, on a risk-adjusted basis, it's been the single best performing asset class in all of real estate because that consistency of rent flows, right? And so like we talked about Class A buildings, not so much, right? The other issue is Class A buildings, we moved into here, our landlord spent about $250,000 to do TIs to fix this thing up for us. Not cheap. If our company doesn't do well, or we decide we're going to downsize, we might be getting out of here when our lease is up, and we're going to have a hard time finding someone to replace that, and they're going to have to put a lot more money into it. Apartments, not so much, right? Apartments, you're maybe putting in some new paint, some new carpets, and they're always, especially today, with this Airbnb rental type of generation. People, millennials, love apartments, so it's a great place. And so when you look at it from that standpoint, again, I think the perspective I can give your audience is we deal with everything, right? Real estate, what we really look at real estate is as an income source for our clients, right? We're not, the capital appreciation, we believe it will come over time, but the tough thing about capital appreciation, as you know, Barry, it's tough the time. I can't tell you if that capital appreciation is going to come in the next 24 months, 36 months, or we could hit a huge recession, have a dip, and it might take you 10 to 12 years to get your money back. We saw that happen to a lot of people in 08, 09. But if you have good, high quality tenants and the consistency of income, the income is really what you're worried about. Like I tell people, even in the stock market with Procter & Gamble over the last 62 years has gone like this. So on a year-to-year basis, you could have been up 10%, down 20%, whatever it is. But the dividend, the income that they pay to their investors, not only has that been stable, but for the last 62 years, it's increased every year. And so we kind of look at real estate like that also is, how do we find properties, whether that's commercial, residential, where we have a high quality tenant. There's not a lot of risk to losing them or someone being outsourced, being kicked out, that we can count on the income. Hopefully we have some escalators in the rent there. We know the capital appreciation will happen over time. We can't manage or control that. What we really feel like we could do by screening good tenants, buying in the right areas, all those types of things, and doing the research, is we cannot guarantee, obviously, but we can have a good high quality and conviction that the income source coming in is going to be enough for our clients. And so when you think about why do we do anything, Barry, it's because we all hopefully are building a lifestyle that we love, right? And that lifestyle we can quantify into a number, whether it's $100,000 a year you need to spend, 500,000, a million, whatever it is, you can quantify it. Then our goal for our clients is to say, how do we get our passive income source to be able to generate enough income to fulfill that for us without having to go to work every day, and make sure that that's consistent? So real estate, and we have like a 4-bucket strategy. One is just your liquid money you pay bills with. 2 is our income bucket, then growth, then speculation, 3 and 4. Real estate, we really kind of, the vast majority of it, we look at that bucket 2, where it's the income that as bucket 1 gets depleted and pays bills every year, we're collecting those rents, collecting those dividends, and replenishing that. And then when we talk about our bucket 3 or 4, if we want to look at opportunistic real estate, opportunity zones, maybe there is, a crash in the market, and we say now really is the time, like Blackstone, we partnered with them in 08, 09, they were buying whole communities down 60 and 70%. That worked out really well. But that capital appreciation and opportunistic real estate for us really needs to be more timing, kind of going out there, like Warren Buffett would say, is be fearful when others are greedy and greedy when others are fearful. That's when you want to look for the capital opportunities to make that appreciation. But in a market like this, we talked about, where nothing is really cheap, what we're looking for is solid resources, multifamily, self-storage, industrially warehouse space, because obviously what's going on, Amazon's doing pretty well. We're buying places where Amazon's the tenant, FedEx is the tenant, UPS is the tenant. Those are things we have a high level of conviction in. I can't tell you how much they're going to appreciate, but those rent rolls, that cash flow, that's really what's important. So when you talk about cap rates and all those things, we're not looking for negative cap rates and hoping to make that up on capital appreciation.
And that's a great thing about cash flow, right? And dividends, when you have that, right, it keeps the lights on, right? If whatever else happens, if you have that cash flow, that asset is going to stay alive. It's not going to be foreclosed on, or it's not going to be taken away, right? If you have that cash flow, it just keeps the lights on for all the time. That's interesting. You mentioned the 4 buckets there. I'd be interested to see how you guys like to give the allocations to each bucket, right? So like you said, it's I love that analogy, by the way, of each bucket. You put a little bit in each bucket, right?
Yeah, so that's kind of what I teach an entrepreneur roadmap class in my course in my class, and I teach the bucketing strategy. So let me tell you what's kind of cool about the bucketing strategy is I did a lot of work early in my career for pension funds. And so pension funds use something that's called liability-driven investment approach. And all that really means is, if I'm General Motors, I've got 100,000 employees that are going to be retiring at different times. They're going to be living different amounts of time. Obviously there's life expectancy. So unfortunately, we're all going to die at some point. So you can kind of have those calculations relatively dialed into when you're going to need cash. And so if Barry retires in 20 years, okay, we know he's going to start needing this amount of money every year. And so when they do that, you don't do that by randomness. They don't put a bunch of real estate and stocks and say, well, hopefully we get this average rate of return and it all works out. What they do is they buy calculated assets, bonds, very low level risk assets to mature at certain amounts of periods of time so that they're there to pay you. But what they do on the back end is they try to make sure they're replenishing those low return assets with higher risk that they could take over time, meaning you, and how we break this down for individuals who don't have, like an endowment or a pension, it doesn't need to go on in perpetuity. It needs to go on until we're dead, which for most of us is usually by 100, unfortunately. So what we do is we calculate our bucket 1 is really just our bonds, our CDs, the stuff that doesn't pay a lot, but we know when you need to pay your bills, it needs to be there, right? And so what we figure out for our clients in bucket 1 is, how many years are we kind of comfortable with things? So we try to have about 2, 3, 4 years worth of our expenses there. So if you have, $100,000 annual expense. We'll keep about 300 to 400,000 there, and very low risk things. Now you don't have to put exactly that because the bonds will earn something. Today it's not much. So if you need 400,000, it's about 380 you got to put in there. But then the idea with bucket two is what we're trying to do. If we have 4 years worth of expenses in that bucket one, obviously when you peel one off to spend 2021, that only leaves you with three. Well, how do I replace that? So that's really our income in bucket two. We're only focused on income. So we will buy a stock like Procter and Gamble. I don't know how much it's going to appreciate, but I'm very comfortable with the dividend. We'll buy multifamily properties in there. Anything that's paying an income, real estate investment trust, maybe some corporate bonds that are paying a little bit of higher rate. The mandate for our bucket two is it has to pay an income that is a consistent income. And we do a deep down analysis to make sure, okay, if it's a stock, for example, we used to own Exxon. Well, we decided a couple of years ago, even though they're paying a dividend based off of the ratios, the leverage, what's going on with oil, we weren't comfortable earning that anymore. So our sell discipline got it out of there. So we don't really care in bucket two how much it grows. Obviously, things grow over time, but it's really more about that mandate and what we call a low risk portfolio. And risk is very dynamic. I think it's not really understood by the general public. I think in the financial advisor community, we have people fill out, well, how risky are you? Well, let me tell you, doing this for 22 years, when stuff's going up, everyone is really risky. They feel really good. And when what hits the fan, nobody wants to take on any risk. So that's not really good. But what we consider lower risk is when you can get most of your money that you need to live off into that bucket two, the low, the multifamily that's, low or no leverage, the high quality blue chip stocks, corporate bonds, good real estate investment trusts, things where the income alone without the appreciation replenishes that bucket one every year. Now, you can't get there right away, obviously. So then we have bucket three, where that's our growth stuff. So from a stock perspective, everyone knows Amazon. That's kind of where we have our Amazon in bucket three. It's longer term. We're not counting on it as much. We know it's going to go up. But if we need to pay our bills, we don't know what Amazon's going to do on a year-to-year basis. What we do annually is we'll review that bucket three, though, and say, hey, bucket three did pretty good. Amazon's up 100%. Let's maybe peel some of that off the table. Or, hey, we found this really great deal that was in foreclosure. We flipped it, made 80 grand. Now what do? Well, then we'll peel some of that and put that back towards that bucket too. So where somebody might not have been in a position where 100% of their income was funded for bucket two, we try to get there through harvesting that bucket three. And then bucket four, we don't always get clients there, but that's what we call our home run, our moonshot approach, very highly speculative private equity, like really crazy, highly leveraged deals, to where a lot of times what we do is we've already secured our clients pretty much their financial future in those first three buckets. Now it's kind of like, okay, let's kind of shoot for the moon or second generation money. That's when we'll go after these IPOs, private equity deals, crazy levered real estate deals. Because look, if you've already secured your future, Bitcoin, those types of things, that's our bucket four. And so what we do first, though, is tell people, just kind of like building a home, get the foundation set first before you're worried about what kind of ground countertops you're going to put into the kitchen. And so that's kind of how we approach it. So I wanted to do was take the way that pensions manage money, but put it into a way where the average person could understand it, buy into it, analyze their things differently. So when I tell our clients, hey, bucket two, Procter & Gamble was down 20%, but it paid the income. That's what we wanted it to do. They're okay with that. Or when bucket three, things go a little bit crazy. Well, we're not counting on that for 10 years. And so that's one of the biggest things for the average investor person listening to your show is my undergrad's in psychology. So behavioral finance, behavioral economics is very real. And one of the most important things, there's a lot of strategies that work. Buying multifamily, doing commercial, whatever it is, my strategy, your strategy, it's not the only strategy. The key is those strategies all operate a little bit differently. They have different ebbs and flows, different up and down cycles. And if you're somebody who's going to hop off one thing onto the next, constantly chasing performance, I've seen it for 22 years, you're never going to go anywhere. So you need to buy into something that you can stay the course with through the ups and downs, no matter what it is. And that's going to be the best thing. So that's what we try to do is create a platform that behaviorally we can engage with our clients and get them to stay the course in, because otherwise, they're going to be too scared. They're going to sell at the wrong time, buy at the wrong time. Just like COVID last year, stock market, everything crashed 20-30% in Q2. Because our clients are educated, they stayed the course. If someone would have sold down 30%, well, look what happened. Everything rallied back up and there was 10+% years for everyone. If you would have sold down 30% and went into cash, it's going to take you 180 years at 1% to break even. So that's one of the keys that why we created that bucket system, is to educate people on what you're doing and how we're making decisions, not just investment decisions, but how those investment decisions tie in to your personal lifestyle. And once people can tie it into, oh, that's how I pay my rent in Idaho, or oh, that's how I send little Jenny to college, and that's why I'm investing, it's a lot more tangible then.
Yeah, I love that. And I think that's so important. You said the personality aspect of it, right? Because there's people being successful in all kinds of business, in all kinds of real estate, in all kinds of investments. But you've got to find something that sort of resonates and makes sense with you and that you kind of like and believe in, right? Because if you believe in it and liking it, it's going to make a huge difference. You can ride out the bad times and you're going to enjoy the good times even more. So I love that you guys do that. I know it's different on age. So, and is that what you decide, how you decide on allocation and how much to put on each bucket?
Yeah. So, I mean, the goal would be as you get, and, I personally don't believe in retirement. I don't ever see myself retiring, right? Especially I'm not out, digging ditches or anything. So I love being engaged, but it's really more a financial freedom date, right? It's the date to where, for me, it's when does my bucket 2, just my passive income, give me enough cash flow to replace bucket 1 where I don't have to worry about capital appreciation. For me, that's kind of where I'm, trying to get, and we try to get people there as soon as possible. Now, if you're a professional athlete that we work with that signed a $100 million contract, even if you're 21, I could get you there a lot quicker, right? So it's not based so much off of age, it's based off of how quick can we get you there. And so that's why I work with a lot of entrepreneurs also, because, again, we talked about being the best at what you do, adding value. Information is free these days. So the average, the days of the stockbroker in the 80s selling you a hot stock for 10 grand, it's kind of over. So in our economy, in our industry, it's had to evolve. And one of the ways that I've been able to achieve success is working with entrepreneurs and helping them build, grow, and scale their business. Because, what I say all the time is people don't get rich from investing in one piece of real estate or investing in a hot stock. They get rich from a stream of income that is greater than what their lifestyle is, and taking that stream of income that's in excess and investing that into good real estate deals, investing that into good stocks. But you can't start with $10 and not get there. So I try to get people on their career path to entrepreneurism, getting their business free cash flowing where they can put good chunks of money into good assets. And so in terms of, age, it's really about how do we get you to that scenario where most of your income is in those good, solid multifamily deals. We like self-storage, good, high quality dividend paying stocks, the low risk assets. Now, when you're younger though, because you're not making as much, you do have the ability to take on some more risk though. And so if I'm 20 and I don't really want financial freedom until I'm 55, well, then we'll say, hey, if you've got at least 10 years, maybe don't worry so much about that bucket 2 now, because you don't need to pay interest on dividend income. Maybe focus on those Amazon stocks, focus on maybe looking at Nevada, looking at Florida right now, Texas, these low income tax states, as you see states like mine, California, continue to just kill people on taxes, and people are moving out there. States that are a little bit more flexible with this new type of economy that are not shutting down businesses. This is a real movement that's going on. And so now, is that going to play out, come to fruition in the next week, 2 weeks? I don't know. But if you can be opportunistic in some of those areas and wait, invest ahead, like Gretzky said, a sports analogy, skate to where the puck is going, right? If you can start investing in some of those places, when you're younger, you have that luxury of time to where if you're 60, 65, you can't wait 10, 15 years. So again, when you bring that bucket of narrative into there, not only are they the asset classes that are tied to it, but it's the time frames we associate with each bucket also. So younger people take more of those bucket 3, 4 types of strategies, but not at the expense of putting everything there so risky, because I've seen young people do that for too long and just put everything there chasing just Bitcoin. Like, hopefully I own a little Bitcoin. Hopefully it works, but if it doesn't, I don't want my lifestyle to be dependent on the outcome of that. So it's really balancing some of that. And it's just, you know, what a lot of people want, well, what's the simple equation? It's really not a simple equation. And that's why, you know, one of the things I learned from 2 MBA degrees is frameworks. I like frameworks better than models, where a model, someone tells me exactly what to do. Because to your point, I'm not you. I don't have the personality that you have. Some of these other guys saying, oh, just do this and follow this. Well, if I'm not you, I don't have the same experiences, same personality, same value. I can't do that. So what we try to do is give people a framework so they could take what they do and put that into a framework to be successful. So that's kind of what we teach and what we do at our firm is we create a framework that's not one size fits all, but it's an ability to put something into a system based off of who you are and what you're trying to accomplish that you can execute on.
Yeah, that's really interesting, and I love that concept a lot. It just makes a lot of sense, right? You've got to apply that, right? Because, like you said, everyone is different. Everyone has different goals, different personalities, different outlooks to life.
Right.
You've got to take that into consideration. So I think that's really important. You mentioned something there earlier about risk, right? People don't understand risk, right? It's either risky or it's not, right?
Yeah.
But when you guys evaluate risk, how do you guys kind of do that? Because I think understanding risk is so important in what we do in both real estate and just investment in general, right?
Yeah, it's hugely important, and like I said, it's very misunderstood by the general public. And you know, in our industry in particular, what we calculate risk on when we do these, if you go to any financial advisor, you do an online risk test of what kind of investor you are. It's really based off of one thing, which is standard deviation. And not to bore your audience, standard deviation is just a variation from the mean, meaning how volatile is that asset class. So to give you an example, you know, we talked about Procter and Gamble. We'll just kind of stick with that theme. Well, it's an older company, toilet paper, toothpaste. It's not you know, the next Zoom. It's not the next Facebook, obviously, but it's a consistent, steady, cash flowing type of business, right? So it's going to be lower risk and have lower volatility. Well, so let's stick with Zoom. Well, Zoom, obviously, very new economy, very high growth. It's got volatility all over the place. Real estate in particular sometimes is going to be volatile. The key as an investor, what you have to do is separate volatility from risk. So volatility is going to be there, whether it's a stock, whether it's a piece of real estate, it's going to go up and down. And if you're in a position where, like I said, you can't handle things going up and down, and you're going to sell every time something goes down and you're scared, whether that's real estate, stocks, currency, buying high and selling low, you don't need an economics degree. That's not what you want to do. But it comes down to, like you said, really, when you understand what you're doing, when you're passionate, you like it, and you have, like talked about on Fox today, conviction. This is a market where you need to do your research and have conviction, because we have an inauguration next week. We have COVID going on. There's so many headlines right now, and with, you know, social media that's tied to our phone and all these things that we're inundated with, people are making so many irrational decisions. But when you understand that multifamily unit that you purchased has very low leverage, you have high quality tenants, it's in the path of progress, there's great things going on around there, even though it dips 10, 15%, are you worried? No, you're probably looking, should I buy more of those units? So what I would say is these risk tests are basically just going to base things off of volatility, right? Amazon's another stock I bought 17 years ago. I put about 10,000 into it. It's a lot more money than 10,000 now. I've never sold a share, and it's dropped over 20%, probably 20 times, but I've always had conviction in the model. And so the risk of Amazon going to zero, to me, risk is losing your money. It's permanent impairment of capital. That's what I consider risk. So my clients say, if I'm going to put into this, how risky is? Well, you're not going to lose your money. Amazon's not going to go out of business. I could tell you that. People say, oh, you can't say, it's not going to go out of business. And trust me, I'm going to see it way before Amazon goes out of business, that I'll have a chance to get you out of that. Blockbuster didn't happen overnight. You had a long time to sell your Blockbuster shares, right? But is Amazon going to be volatile? Absolutely, right? But you as an investor need to understand that. And that's the challenge when people invest in stocks or things they don't understand. They just see ticker symbols that aren't tied to anything. They just get scared when they see the value down. That's why we use a lot of individual stocks and tell the story and get our companies to buy. Because when I could tell people during COVID, open up your pantry. Do you have any Pepsi products, or do you have any Procter and Gamble products in there? Oh, okay, yeah. They feel more comfortable. And so to your point, and why a lot of people, again, behavioral economics, behavioral finance is important, why a lot of people like real estate is because it is a tangible asset. You can go out there, touch it, feel it. People understand that. It should be a large part of anyone's portfolio that you're investing in, because more than likely, again, especially risk comes down to leverage also though, right? So if you're leveraged so much that if you do lose a tenant for 3 months and you can't afford to pay that debt service on it, well, that's a problem. So, one of the ways when we talk about risk in real estate is you want to remove risk, remove leverage. Because if you don't need the money, right, and you can wait for someone to come back in, that's what hurt people 08, 09, right? There was like General Reeves, some of these people that went out of business, they still had good quality tenants, but the banks got in so much trouble, they had revolving loans. And when they went back to these guys and said, hey, we need you to put down another 30 or 40 million to bring your valuation up higher, everyone was paying the rent, but they didn't have that cash flow. They were over levered and forced to sell. So there's a lot of aspects of risk, but one thing I would say is separate risk from volatility. Volatility happens. Risk is, do I have a real potential of losing my money here? And that's, usually, I think, those types of deals, highly levered, speculative, maybe a crypto, Bitcoin, I think it's probably becoming more mature now, but there's some of these other ones that maybe not so much. The deal that your brother heard down the street that, 2 guys are now all of a sudden restaurateurs that they want you to invest in that. Those are the things where, a lot of times when I invest in those things with friends, family, I don't do big investments, but it's like, hey, if I get my money back, that's real risk. The risk is it's probably going to go to zero, and I look at it that way, and I'm okay with it that way. But yeah, I know that's a lot, but that's risk, volatility, and leverage. Those are the types of things that go into analyzing the risk.
Yeah, no, but it's important. That's you explained it really well. I appreciate that, because it's important to understand, I think, right? Just to understand that risk is more than either it's risky or it's not, right? There's more that goes into it than that. And while we're on the subject of risky, I'd be interested to hear your take on, you mentioned it a little bit there of I'm sure you guys have an eye for the future, right? About what's going on, right? And none of us can predict anything, right? But are you guys doing anything differently right now with an eye to the future that maybe you weren't doing a year or two ago?
Yeah, well, fortunately, I have a really nice crystal ball, so I just look at that every time. No, I mean, like we just analyze all the data that's available. We use something called game theory, really, where we try to take the data in, and then we just kind of look at what are some of the potential outcomes that could happen based off of the data that we have. And that's really how we diversify. When you talk about diversification, real estate, most people say, oh, put a little in real estate, stocks, bonds. Yeah, okay, that's a very broad, simplistic level of diversification. But when we try to diversify, because even with stocks, being in technology stocks is different than being in financial stocks. And real estate, being in Class A commercial is different than being in multifamily. So you can't just say stocks, bonds. So what we try to do is take these broader economic outlook, microeconomics, bottoms up, and say, what are the scenarios that we're facing right now? So let's look, for example, at COVID. Well, we're hoping that everyone has maybe a vaccine by the summer, things get back to normal, reopen. That's one of the things. Well, what if a new strain comes in, right? And we don't have a vaccine and this gets worse and we're into this deep into next year. That is not priced into this economy right now. And that's not a black swan event. That's probably, that could happen, right? So if you're preparing all in, oh, the economy is going to open back up, consumer spending is going to take, hopefully, maybe, and yeah, you want to have some things maybe geared towards that to benefit from that, but what if it doesn't happen? And so what we're looking at right now is kind of the baseline is that things do start to reopen third, fourth quarter this year, more than likely. We think interest rates are going to, I'm just giving you kind of what what we think is in general. Interest rates probably will stay low for quite a while. The Fed's already said, so probably about 2023. Chairman Powell was just basically talking again the other day, reiterating they don't have any intention on raising rates anytime soon. We think that businesses are going to continue kind of this remote work from home type of thing, probably into next year for 2 reasons. A lot of people are saying, oh, play this kind of stay at home trade, if you will, and that things are going to go back to normal. Things are not going back to normal. Psychology has changed with people. So people are always going to buy more toilet paper than they need to. They're always going to buy more Clorox wipes, right? But the other thing besides psychology is that corporations are seeing now, based off of why the stock market rallied last year, is that bottom lines are getting improved. So when people are doing like we're doing now, Zooms, and not on planes that cost money and staying in hotels that cost money and eating at restaurants on the corporate account that cost a lot of money, well, that's actually better for the bottom line. Our company, Wealth Management, it used to be take clients out to dinner, go do these live engagements. We brought in the vast majority of our clients over Zoom last year without ever meeting them face to face. And when you could set that up, that's actually a much more scalable business than have to get on planes and fly around. So we think you need to start thinking that this economy has changed. And so when you think about it from that perspective of real estate, I wouldn't be investing in anything Class A commercial right now. I would invest in multifamily, self-storage, industrial warehouse. That's where all our money is right now. We're not in anything other than those areas. We're definitely not in restaurants or shopping malls or anything like that. Now, could there be a time and place where because they get beat up so bad that it's an opportunity? I myself would love to buy New York real estate, but we're nowhere near there. There's no blood on the streets yet. Could there be? Yeah, that's when I would do it. And like I said, I'd buy anything. Would I buy, shopping mall? Yeah, if it's 40%, 50% lower than it is today, I would consider it. So, what I would say is stick in real estate, stick with those high quality cash flowing assets that are not going to be impacted by a longer, challenge, a deeper recession. In stocks, we're kind of sticking with those types of companies that have good cash flow, good solid balance sheets, don't have a lot of leverage, and some of these names like Zoom and CrowdStrike and so forth that are really facilitating this new economy that people are going to. One thing, I've been talking about quite a bit in the national media is I think one of the worst places you could be is cash though. I'm not a dollar bear or doom and gloomer or gold bug or anything, and I've never been in my career. But I'm definitely concerned globally with what's going on with fiat currencies. The fact here in the US, we're continuing to push more and more money. Last year in terms of money supply that got into our economy, it was the largest increase since World War II because of the stimulus. We could see that increase even more this year. And one thing I learned a long time ago in my economics class is you need two things to create inflation. One is supply, the second is velocity. We've had a lot of supply since 2008 because of the banking crisis, but that's a lot. Supply got locked into the banks because they were in such bad shape. Well, banks are healthy now. They brought up their tier ratios. And so now that money, you can see, look how many people are buying new homes, refinancing all these things because interest rates are so low. That money is being pushed into the economy. A lot of people don't really need these stimulus checks that are coming in. I've heard a lot of stories about these PPP loans, people buying boats and other things. So this is a lot of, I'm not saying everyone's doing that, but that's a lot of money that's overstimulating the economy. And we got off the gold standard in the US a long, long time ago where we needed to have something tangible backing that dollar, where today it's pretty much anything. Hence this run up in cryptocurrencies, and people really look for something different. And if you look at currencies over a long period of time, that reserve currency status, it usually lasts about 100 years. We're about 103, 104 right now with the dollar. I'm not calling that, but if you're not thinking that this could be a risk, you're not really paying attention. And cryptocurrency, a lot of people are brushing that off. Well, JP Morgan's not, Guggenheim is not. A lot of large institutions are now putting 5 up to 10% of the necessarily think it's going to skyrocket because they need a hedge. And so what you're looking at now is, I think you want to look at those things. Dollar under pressure, don't just sit there in cash. All those types of things I think are an issue right now.
Yeah, and I think from a real estate standpoint, I think this bodes well. The inflation, I think real estate's a good hedge against inflation, right?
Absolutely, very good hedge.
Yeah,
so it's a tangible asset, right? So whether it's the dollar that buys that real estate or Bitcoin or some new currency, that real estate's it's going to still have value. The paper, the dollar might not have value, but the piece of real estate will. How that deal is transacted and what currency, that could be different.
Yeah, and it's definitely an interesting time because I feel like there's more changing than there has been for a while, right? And like you
Absolutely.
said, who knows what's going to happen with the dollar? The yen is a danger to that, I think. So yeah.
And the challenge is the speed of change, right? It used to be you could see risk. When I started 20 years ago, you could see risk. take a month, 2-3 months with your investment committee. How are we going to position? Well, things today like happen at the speed of light. You don't have that time. You know, they say like the stock market, which I think is just the pulse of the economy, it takes the stairs up and the elevator down. I think that's more so now than ever. Like when something goes wrong, you don't have a lot of time. You got to start thinking now and positioning for it now, because by the time it's out there, public news, it's too late. Everyone's already sold on that.
Yeah, so true, so true. Man, this has been a fascinating interview. Really so interesting. You bring up so many great points, and it's really nice to hear somewhat, not a different perspective, but a different viewpoint, I guess, in terms of how you analyze risk, how you guys look at investments, what you advise your clients. It's really interesting, man. So I appreciate it, and I appreciate you being here. But as this show is called Wrestling with Real Estate, I like to incorporate some wrestling-related real estate questions. So the first question is, what would your wrestling name be if you picked one for yourself, you think?
My wrestling, I think I'm going to go with Rob McBucks. I'm a big Scrooge McDuck fan. I've got some paintings done by some artists in my house. I'll go with Rob McBucks.
I love that, Rob McBucks. I love that a lot. So every wrestler has a special move. What would your special move be in investment or business? What is your biggest strength, essentially, you think?
Yeah, I think I'll be the analyzer, right? And that kind of helps with negotiations. I'm very analytical on the deals, and we have a saying that analysis and data kills emotion. And so we're able to use data sometimes to really help negotiate. So when you show somebody it's not worth what they think it is, especially in real estate, and you provide data to back that up, we usually work out pretty good. So I would say the analyzer.
I love that. I love that. What's been the biggest body slam you've taken in your career for so far, you think?
Well, you know what, I'll say because of real, I've taken some losses obviously in the stock market like everyone has, but I think in terms, since this is a real estate show, I'll tell you one thing. As I was doing an investment property out in Arizona, it was one of these fixer uppers, gutting it out, and talk about getting better by learning from experience. This was quite a while ago. I had a contractor file bankruptcy on me in the middle of that, about $150,000 into him. And so thankfully I paid for the windows through Amex. Actually, Amex gave me all my money, but I still lost about $100,000 because good luck trying to get your money back from a bankrupt contractor. So you guys that are in there fixing up, make sure you're a little bit more astute on who you're paying, what you're paying these deals to, because a lot of these contractors, as you know, Barry, are not that financially sound, and they're kind of one deal to the next. And so that was a lesson learned, to be a lot more careful with when you're using contractors.
Yeah, it's definitely a challenge working with contractors, unfortunately. I think, and I hear it time and time again. So I'm sorry that happened, man, but I'm sure it was a learning curve, right? I'm sure.
I share that knowledge with all our clients now when they get a contractor. So it's I'm getting it paid, but it was good tuition.
Yeah, absolutely. So was there a moment that you were standing on the top rope, getting ready to jump, but you were too scared? What was it, and how did you overcome it?
Yeah, so I guess what it was last year. I started my wealth management firm in 2002 out of my bedroom, built it up as an entrepreneur, and I've been approached over the years from people who wanted to buy into us. But in January, actually, we closed in January of 2020, but I was approached late 2019 about selling majority interest. I sold 70%, and it was scary, right? Because I was 100% owner. I called my own shots. This is a big publicly traded company who bought us. I almost didn't do it, but then I kind of looked at everything, and why I think it's very important to understand, as even an entrepreneur or real estate investor, your own personal finances. When I could tie a number of what I needed from the business into my own bucket too, and what they told me at first I said no to, and the number 2 or 3 offer made sense for me personally. That planning that I did made sense. It helped me. Then I was able to have the confidence to say, okay, and take on that risk of things not working out. Thankfully, a year into it, things are working out okay. But that was one of those things where I was pretty scared to jump, but did wind up jumping. And luckily there was someone underneath me when I fell.
Very cool. Very cool. Well, Rob, hey, this is, like I said, this has been so fascinating and so interesting. I really appreciate you taking the time. You're obviously a very busy man and very successful as well. So I appreciate you sharing everything that you have today. But before we go, do you want to tell people a little bit more about where they can find out more about your company, about what you guys do, about you personally, and if they want to reach out and somehow get in touch with you, how can they do so?
Yeah, it's great. I'm going to keep it easy for everyone. Just go to robluna.com. Everything about me is there, robluna.com, and you can find out all about me, and love to engage with some of you guys out there.
Perfect. Well, thank you. I'll put the links in the show notes in the description below so people can find that. Rob, thank you so much, man. Have an awesome rest of your day and enjoy your weekend out there.
You too. Thanks, Barry.